Welcome to the Financial Advisor Success Podcast, where you go behind the scenes with financial planner, speaker, and consultant Michael Kitces to hear stories of how leading financial advisors navigated the inevitable challenges that arise on the path to success, and get insight from leading industry consultants about how to break through to the next level in your advisory business. And now here's your host, Michael Kitces.
Welcome, everyone. Welcome to the 398th episode of the Financial Advisor Success Podcast. My guest on today's podcast is Eric Wulff. Eric is the CEO of Marcum Wealth, an RIA based in Cleveland, Ohio that oversees $2.5 billion in assets under management for approximately 2,700 client households. What's unique about Eric, though, is how he has built Marcum Wealth into a multi-billion-dollar firm under the umbrella of a national accounting practice, in large part by cultivating mutually beneficial relationships with the firm's internal CPAs to get them comfortable providing referrals of their accounting clients to the financial planning business. In this episode, we talk in depth about Eric's process for generating internal referrals from the accounting firm CPAs, which do not come automatically despite the affiliation between the accounting firm and the RIA. How Eric's firm takes a give-to-get approach with CPAs and their accounting clients to try to demonstrate the value of planning it can offer both them and their clients so that the advisors in his firm are top of mind when accounting clients really have deeper financial planning topics or face a life transition. And how Eric's firm's exit planning services in particular have been able to drive referrals by helping the accounting firm CPAs maintain long-term relationships with their business owner clients as those owners plan to monetize their businesses, encouraging a continued relationship between the client and the advisor and the CPA when they eventually sell their company and otherwise might no longer need traditional business accounting services anymore. We also talk about how Eric has created a systematized planning process to create a common standard across its multiple advisor offices nationwide. How Eric's firm uses a centralized planning team to prepare financial plans in a consistent manner and allow its advisors to spend more time working directly with clients. And how Eric has found success presenting financial plans to prospects before they become clients, despite the unpaid upfront work that it takes to prepare and present them, as it shows the prospects specifically how Marcum Wealth can meet their planning needs and encourages them to start an ongoing planning relationship to implement the recommendations. And be certain to listen to the end, where Eric discusses the key differences between CPA firms and RIAs, particularly the contrast between the goal of CPAs to maximize the efficiency of their billable hours and the more long-term client relationship building approach done by financial advisors. How Eric approaches acquisitions, targeting younger or mid-career advisors who want to grow and develop their practice within the local Marcum CPA firm, rather than approaching retiring firm owners to acquire as they exit. And how Eric's firm not only survived the 2008 financial crisis, which occurred within 2 years of Marcum Wealth opening, but was able to use it as a growth engine for the firm as more consumers began to recognize the benefits of the RIA model for financial advice. And so with that introduction, I hope you enjoyed this episode of the Financial Advisor Success Podcast with Eric Wulff. Welcome, Eric Wulff, to the Financial Advisor Success Podcast.
Thanks for having me, Michael.
I really appreciate you joining us today and the opportunity to talk about the what to me is this ever-growing blending that seems to be happening between financial planning and tax. And on the one hand, we've got this, I find like rise of advisory firms that are moving further and further in the direction of tax. We're doing more tax planning. We're buying software like Holistiplan and FP Alpha to delve deeper in that end. Some firms are even like getting their enrolled agent and bringing tax preparation into the practice. But then there's this whole other end of the spectrum of CPA firms that are coming further into wealth management. The ongoing tax prep business just continues to get rougher every year, and it's transactional and seasonal. And wealth management has lovely recurring revenues, and you can meet with clients all the months of the year and not just be concentrated around building up to April 15th and maybe extension deadline. And I know you have lived kind of a version of this journey of building an advisory firm within a CPA firm and what it looks like when the CPA business comes more in the wealth management direction. And so as so many wealth managers are building towards tax, I'm excited today to talk about what happens when the tax or when the accounting business tries to start building in the wealth management direction and what that opportunity looks like in an accounting firm.
Yeah, it's an interesting direction the business is going as it continues to evolve. And what was once before was now coming back full circle again. So we've been here before in terms of accounting firms offering financial services advice, and it kind of went away, and now it's kind of coming back into a different version, a different approach.
Yeah, because I guess there was a version of this, I feel like, that cropped up back in, I guess, like the 80s and 90s, where a lot of the big accounting firms, I guess it probably would have been like Big Eight back then, had these really deep financial planning practices that often were working with like executives at Fortune 500 companies. The accounting firm would do all the accounting work for the big corporation, and then one of the employee benefits was financial planning for the executives, and many of those folks actually moved out and launched RIAs back in the 1990s. Some of the early RIA firms. So you're right. It's interesting to me that now we seem to be in a fresh resurgence of this, where accounting firms once again are looking more and more in the wealth management direction.
Yeah, I think it's the accountants live at the center of the trusted advisor universe, along with the attorneys and the financial advisors, and they're probably the most go-to people for most business owners and high net worth families. They always are integrating their CPAs in the process, and the CPAs are looking to figure out how they add value. Right, that's what everybody's focus is in terms of professional services corporations. Do you deliver value to your client base?
So I think to get started, help us just understand the advisory firm itself as it exists today. So want to understand the advisory business first, and then we can talk a little bit more about like how this relates to an accounting practice and how growth and business development happens and has occurred over the years.
Yeah, so basically, we're set up as an independent RIA. And we have obviously an affiliation with the accounting firm. It's a shareholder in the business, but we've built this firm as an RIA firm, not an accounting firm, and I think that's one of the advantages we've had. Versus say CPA practices, trying to basically launch RIA firms, but they run them like CPA practices. And so it's obviously a different financial model. It's a different set of services and skills you're bringing to those clients. But the idea is, is we're always focused on how do we add value back to the core client base. And today we're, roughly, 2.5 billion in regulatory AUM. We have about another $500 million in 401k plan assets, about 60 people in the practice today across multiple states, multiple office locations, largely within our office locations or within the footprint of the accounting firm, and continuing to expand. And I think what really one of the things we had to realize early on is standardization. So as you're deploying out a model inside of an accounting firm practice, you can't do something different in one market than another market. So one of the things we really focused on early on was how do we standardize process inside the firm, from financial planning to investment management to compliance to service models, really being able to have that Marcum Wealth experience across different locations, different advisors, different geographic natures, different types of clients, but still having a centralized process about how we go about working with clients and helping them achieve their goals.
So I feel like standardization is one of those things that advisory firms don't tend to focus on until we get quote unquote larger, like we have multiple locations, and suddenly there's this realization of, oh, the advisors in the office here are not quite doing the same thing as the advisors in the other location. Like maybe we need to standardize this further. Is that how it evolved in your world as well, or is there like a different context to this when you're building attached to a much larger CPA firm that I guess I'm assuming probably already has multiple locations in multiple markets?
Well, it was interesting. The funny thing was when we were at Morgan Stanley, from '96 to about 2006, we always kind of questioned. It was a little bit odd. You go and talk to 11 different or 10 or 11 different investment advisors inside of Morgan Stanley, you would get 10 or 11 different responses of how to actually do something.
Yeah.
And so we said that always kind of bothered my business partner, Chris Bart, and I, when we were originally at Morgan Stanley. It was kind of like, okay, well, is this the right way to do this? Right? Should we have more of a standardized approach where the whole firm weighs in on how we best deliver results to our clients from a planning and investment perspective, a process management perspective. And so we felt like from the start, we really wanted to make sure it was, it was going to be consistent. So whoever the advisor was, whoever the team member was, they could always walk into that situation with that client. If a client called in, they'd always understand how exactly why a client was positioned from their investment portfolio to their financial plan. And then that opened up the door to be able to scale it and really continue to grow the business without having to worry about plateauing out. So we kind of looked at it and said, we got to be consistent in this deliverable, because when you're working with accounting firm partners, you can't do something different from one group of partners than you're doing from something for somebody else, because they're going to talk, they're going to share ideas, they're going to say, well, why is this different? Why are you doing this for one client, not for my other client? And so, knowing that you're getting a referral source, you got to treat that referral source very high standard of care, because if you disrupt it on one side of the firm, it's gonna filter through the rest of the firm.
So how do you think about the balance of that between trying to standardize and what I feel like a lot of advisory firms these days want to push, which is customization, personalization, right? They're sort of by definition, like financial planning is individual to each client and their needs and circumstances. How do you, I don't know, like rationalize or think about standardization for what in theory is a very personalized service to each client?
Yeah, I think it's a fine balance to walk, right? Because I think when you're doing financial planning, it's not cookie cutter, right? Every client situation is unique and different. So if you take, for example, individual families, you're doing financial planning for that family is unique in its own experiences and what they're going through, what they're trying to solve for. And so the advisor who's starting the planning process and working with our planning team is basically gathering the information, understanding the nuances, and then they're going back to our planning team and saying, okay, here's the case. And then they're collaborating together to come up with a plan that's going to achieve the primary goals that the client's looking to achieve, whether it's estate planning, retirement, whatever the car, trying to provide for specific goals in the future. So that is still always very personalized, because it's really the story of the client that you're basically putting a plan around. But it's how you go about the planning process that I think needs the standardization. So our advisors at the firm do not do the planning software. We have a planning team that does all the plans for all the clients. So there's a consistency to how they're scrubbing the data, making sure they've got the right assumptions in there, that we're not basically trying to like solve to make it look good. We're saying, here's what you're telling us. And here's what, if you're on track, if you're on track, great. We're going to show you how to make it more efficient. If you're off track, let's just share the numbers. Let's share what we uncover, and then let's figure out a way to get you kind of back on track. So even though there's every story is different, there is commonality to how we have to go about the process of planning. And so I think standardization with your planning team allows you to basically get that scale, but still provide the customization.
So then, you'd mentioned as well, like building in RA world looks a little bit different than building in CPA world. I think you said like others fail when they try to run a wealth management firm as a CPA firm instead of as an RIA. What is that? Like, can you talk more about what that difference is? Like, how do you see CPA firms functioning differently?
So the main fundamental difference is how CPAs bill their clients, right? It's a rate times hours model generally across most of accounting firms. So they're looking at every waking minute of the day, what their billable hours look like, right? So you're trying to figure out how do you get max realization for the number of hours you work. And if you've got 2,000 hours a year that you can work, how much you're trying to basically maximize the revenue per each hour you do. And the wealth management business is a little bit different, because our I think profitability is driven by long-term relationships with the clients, and being able to deliver service, drive revenues, and get the benefits of the market growth alongside of our client base. And so the mindset is I think the major mindset I saw when I first got into this was saying, you got to kind of give to get. And I think that was the thing that really separated us, is that, we had these big debates with the CPA partners about, do we charge for planning or do we not charge for planning? And, part of what we've done is we said, listen, before a client ever thinks about investing with us, we're going to make an investment in them. We're going to do the planning to show them really what the work product looks like, how we can add value to what they're doing. And the question then, once you get the planning done, is do they need help actually implementing the plan? And that's really, I think, what the advisors really do is, we do a combination of helping them plan, but then we also implement the plan and make sure they're sticking to their targets and adding value along the way. And I think that was the fundamental difference. So there was a lot of firms that were trying to, in the CPA world, were trying to basically charge for every hour of time they were spending on things for every project. That was, clients were like, well, do I want to pay for that or not out of the gate until I see what you actually can do for me, which is a little bit different than when you're doing tax compliance work, right? Which is a pretty straightforward, you put numbers in, you get an output out, and you check the boxes along the way. That's a little bit different than actually taking the time to do planning for clients.
Right. I guess to me, just that really gets to the nature of more transactional by the hour engagements versus ongoing recurring revenue relationship models, right? The advisory business can be very profitable in the long run if we can get a client on board, establish that relationship, and then we still have to do the service for 3, 5, 10, 20 years of providing value for the client. But once clients are on and a relationship is established, they tend to remain clients, and then the revenue recurs, and then we can reinvest in the client relationship. And that's really fundamentally different than I charge by the hour and my profits are determined by whether I can charge more than my cost. I can charge more for the hour than what I have to pay my staff per hour to provide that service. And I'm making a margin per hourly unit of time, which is sort of the classic CPA model.
Right. And if you look at the CPA model, you have to, in order to bill more hours, you have to have more people involved, right? So, with our model, if we can get the capacity utilization right, we can run more volume through a fixed cost structure. So it's a fundamentally different approach to how you run a business.
Because in the investment side, at least, once I build investment models, investment systems, and I have trading software, I have very little marginal cost to add the next 1, 5, 10 clients.
Correct.
Okay. So in that context, then I guess that helps to connect for me why you built in the direction of approaches like centralized planning teams to try to further enact the differences in scale when you can centralize versus just air quotes just hiring more people to do more advisory work. So help us understand, I guess, the team structure or the team structures of how the firm is organized.
Right. Yeah. So everything starts with planning. So let me kind of walk you through maybe the client experience process, and then I'll kind of dovetail into the niche. So each advisory team has their own focus inside the practice. So some focused on work with business owners, some focus working with physicians, some focus working with blue collar, clients, some focus on ultra high net worth clients. So the target of each advisory team in terms of the clients they're going after can vary, but the process we go through with each client is very similar. There's obviously the customization of each client, but the approach we take is standardized as we can try to get it. So, for example, if a team's taking on a ultra high net worth client, it's going to involve maybe more team members involved in working with that client than it is, say, a blue collar client that comes in the door with smaller balance. But they're getting a lot of the same experiences and the same resources the firm leverage across the client base. So once we bring a client in, as we start to bring a prospect on board with our process, the first thing we do is we make that investment in the financial planning process with that client. We always feel like we need to show them the quality of our work to really show the value of the process we bring to the table. And so we make that investment in somebody before they think about ever doing investing with us. I think that's one of the things that's really, that give to get model has always worked well for us over the years. And so once we get somebody through the planning process, we're really then take them to the next part of the approach. So our financial planning process is really designed to help drive what the asset allocation models are going to look like. So we don't really go by risk profile. We're looking at the numbers in the plan and saying, here's what we need to achieve as part of the long-term financial plan. And we're trying to set up our frameworks of our investment strategies to tie back directly to the financial plans. So if you think about it, it goes from client onboarding process standardized to basically financial planning standardized to investment management process standardized, but we still can provide the customization for each of those clients.
So can you walk me through a little bit further, really what this process looks like? If I come, Eric, and I say, hey, sounds great, want to work with Marcum as my advisory firm, or at least I'm interested in and starting down your process.
Mm-hmm.
How does this work? What really are the steps of the process as you take a prospective client through?
Yeah, first thing, obviously, we kind of have what we call our pathway to financial fulfillment. And first thing is, are we a fit, right? That's the first thing we look for with a client or a prospective client is, are we going to deliver what they're looking for, right? So if you're asking us to trade Bitcoin futures, we're probably not the right firm.
Right.
So But if you're focused on planning and you want to focus on really process management, because that's the thing we can control, that's what our core bread and butter of all of our clients. If you look across the board, is all of our clients have a financial plan in place. It's a requirement of the firm. We don't take on clients you're not going to follow a process, because it's really tough to be an advisor to somebody if you can't deliver a process they can follow. And so the first thing is really understanding who the client is, and we basically do this standard deep dive. We gather all the information, we look at all their goals and objectives, and we do develop the comprehensive financial plan that most firms kind of do. And then what we really do is we just present the hard facts, and we say, okay, here's the data that you told us. You're trying to achieve these goals. Are you on target, or if you're off target? If you're off target, here's how we can get you back on target. If you're on target, how do we make it more efficient across the board? Looking at the holistic approach from everything from the investments, the tax, the long-term planning, the estate approaches, all that comes into kind of play. So usually it takes a couple of times to go back and forth, to get the plan right. So we usually just present the initial plan as is, and then we go back and do a couple of updates and edits to the plan. And then we come to an agreed upon thing where the clients are saying, this is the outcome I'm looking for. Show me how you can deliver that outcome before we take it to the next phase.
So can you take me one step deeper into just how the meeting steps and process work? Like how many meetings, what are the meetings? Like I'm just trying to visualize, because as you noted, like you've got advisors and a centralized planning team. So I'm just trying to understand like what meetings happen, and then like who does what between these meetings as they go through the process.
So that's a good question. So each lead advisor has a number of two advisor or associate advisor that they work with. And so basically the lead advisor is really helping the client visualize their goals, ask the right questions, really taking their life experiences and really understanding what the client's trying to do and what the challenges are going to be. And the associate advisor is working alongside of the lead advisor to kind of take a lot of the notes and get the planning steps built and fill out our financial planning questionnaire process that we go through. And so once that's all completed,
so are you gathering all your planning data in the first meeting, or do you like send a questionnaire or some equivalent that clients fill out as well?
The questionnaire has to get filled out one way or the other. So some advisors send out the questionnaire for the clients to fill out ahead of the meetings. My personal approach is I like to basically send out the questionnaire and then say, listen, let's go over this questionnaire as we're talking so I can pull out the information and expand upon what they're putting in the numbers. So it just really boils down to each advisor's style. But in the end, the plan won't get created until there's a questionnaire completely filled out. Okay. That's part of the standardization process. So one way or the other, we got to gather all the data. We got to make sure that it doesn't go forward in our process until all the information is gathered, statements, all the documentation. So our planning team is pretty disciplined in saying, hey, if we're missing certain things, they don't understand things, they're going to go back to that advisor and say, okay, we don't have a complete picture yet. We can't push that plan forward to the next level.
Okay. So I'm taking it then there's an initial data gathering meeting.
Yep.
We're going through this conversation. Lead advisors leading the conversation. Associate advisor is taking the notes, capturing the data, filling in the gaps in the planning questionnaire. So you're a two advisors in the meeting firm to make this happen. So then what happens is you come out of meeting number one, like who takes what, who does what next internally?
Yeah, so the next step is basically the associate advisor is working with the planning team typically to basically come up with the initial draft of the plan. If there's missing documents, or sometimes it takes a couple of back and forth with the client to get all the information. So the associate advisor is making sure that the questionnaire is fully completed and we got all the entire client's picture of their finances. So copies of statements, cost-based information, tax returns, all the stuff we need to really dig into a plan, that they've gathered that. And now most clients don't have all that information ready to go at their fingertips, right? So it takes a little time to gather it all correctly. Right. But then once it's all gathered in, then they're putting in into our system a ticket to be able to have a plan developed. Then the planning team goes back, starts using their processes behind the scenes in terms of leveraging the different software tool sets to come up with the plan and present it to basically back to the associate advisor, who reviews it to make sure that the quality checks are there, that they didn't miss anything. And then they're presenting that back to the lead advisor. Okay, here's the plan. And then once everybody's on the same page, then we schedule the follow-up meeting with the client to present the initial plan that we do for that client.
So you said ultimately, like when the data is gathered, the associate advisor puts a ticket in the system. So what's your, I guess, CRM or ticketing system that you're using to manage all of this?
It was interesting. We actually, we use Redtail as our core CRM system for like note taking and kind of like the basics of CRM functionality, but we couldn't get it to where we wanted it to do in terms of workflow management. So we actually firm-wide, we actually use Zendesk, which is familiar for most people that have used
Yeah.
IT services. We use Zendesk and actually built custom workflows within Zendesk across planning, trading, operations, compliance to really run the day-to-day kind of approach of the firm.
Interesting. Interesting. So, I mean, does that integrate back to Redtail at all, or is it just kind of two
Now,
different
it's
ecosystems like
two
Red?
different it's two different ecosystems, and it's I think I know there's CRM systems that can do a better job of this. We just didn't feel at the time when we were putting all this thing together that we really had the skill sets to kind of maybe do a more advanced CRM system like a Salesforce or something like that, where you can build all the workflows in there.
Right.
So we started as we were growing. We had to kind of find a solution that would basically work for the firm, that would basically bridge the gap between maybe a more advanced CRM system and what a Redtail would offer.
Okay. Interesting. So the associate advisor gets all the data developed, creates the ticket for the planning team, the centralized planning team to start developing the plan. So what does the planning team use to build a plan? What's your software of choice?
The core we use is Money Guide Pro,
Okay.
but we modify Money Guide Pro in terms of the outputs we put into it, into being able to kind of tell our story with the process, because we're linking our frameworks, which is our asset allocation frameworks, to our financial planning process. That's where I think we've done some things a little bit differently. So our goal when we walk a client through the plan is not to tell them how to invest the money, but to guide them through a process where they can make decisions along the way. So often we hear from clients when they go through our process that they feel like they're in control finally of their destiny, because somebody's not just telling them what to do. They're involved in making the key decisions about how to allocate capital for the long term. And we're showing them the different outcomes of what can occur from an aggressive portfolio to a conservative portfolio. And usually what happens in the process is the client points to the sheet and says, that's the outcome I'm looking for. How do I get to this outcome? And that's kind of the point where we then transition this to like, okay, how do we implement the plan to achieve that outcome?
So I'm just trying to visualize, like, how does it work when the centralized planning team is trying to create a plan for a client they've never met? Because they're the lead and associate advisors are in those meetings. Like, how does that? Just trying to understand, like, how does that trade off occur? Like, how do they figure out what's going on when they were never present for any of the conversations?
It really boils down to, taking good notes and really understanding the questionnaire well, making sure all the information's actually in there. So like looking at cash flow needs. It's as good as the advisor. The plan is as good as the advisor is pulling the information out of the client, right? And so you really have to have advisors that are trained to be able to really work with that client to get the entire information, not just try to put out a set of numbers, but really get into the client's head and understand really what they're thinking about and all their goals and objectives, looking at the entire picture and really working with the associate advisor and the planning team to really make sure that's reflected in the document that gets produced.
And so I guess that's part of why you said after the centralized planning team is building the plan, then it goes back to I think you said, like, back to the associate who presents it to the lead advisor.
Right.
This is like your internal, let's make sure we actually covered what we were supposed to cover kind of
Correct.
structure.
Correct.
And so how often does that take some back and forth? I mean, is that often like just collaborative back and forth planning is an iterative thing?
Yeah, essentially, yeah. So like when the draft comes back, it's part of the ticketing system. We can kind of see, we can add updates to it, make quick changes to things. But it's really, if you do a good job on the front end, the back end is a lot easier. But if you're missing key components or you have to do a lot of follow-ups back and forth with the client, that's going to be a little bit frustrating to the planning team because they have to go back and kind of redo the plan a couple of different times to get it to where it needs to be. But like I said, if you do the work on the front end, it makes the rest of the process a lot easier. So we really try to spend as much time as possible getting the front and all the data, everything organized and button up with a standardized approach, so that the planning team knows exactly how to take that data from the questionnaires and the documents we provide them and put it in the system. And our planning team is really smart in terms of they understand what it takes to be like what advisors are going through. They're all deeply experienced, so they can understand these client situations. And it's this kind of standardized approach we've taken is allows everybody to kind of work more seamlessly together because everybody knows what everybody's looking for from an information perspective in order to do their jobs.
And now help us understand further. How do you link I think you said your frameworks, your asset allocation frameworks into the planning process? I mean, are you showing like different planning projections if you use or a model A versus B versus C, and you're trying to show a spectrum of outcomes that way? Like, how do you actually get to that connection between planning software and projections and different portfolio choices that you're trying to present them with.
Right. Well, our director of financial planning and our chief investment officer will collaborate together to come up with a lot of the assumptions that go into our planning process, right? Return forecasts. We're not using historical returns. We're using kind of forecasted returns based upon what we're seeing currently in interest rates and valuations in the market. Because obviously, you can't necessarily look at the last 10 years of bond yields and say, okay, that's going to be the next bond yields for the next 10 years.
Right.
So you gotta have some assumptions you put into your plan, and everything from inflation to medical costs to college costs, all that stuff. So the research team and the trading team and the investment team work well with the planning teams to come up with these assumptions. And what we do then is we don't have model portfolios per se, because when clients come to us, they can come to us with anything. They can come to us with annuities, SMAs, ETFs, individual stock positions. But as a firm, we've got to be able to kind of put that stuff that comes to us in sort of rules and guidelines in terms of a process management approach. So rather than building models, we built frameworks which are designed at the asset class level to give us exposures we're looking for across the board. So what we do is, rather than with the software we use, which is largely built off Orion and the trading system Eclipse, we can then build what we refer to as our frameworks, which have multiple substitute securities in it. So somebody comes to us with 3 SMA portfolios that are all U.S. equity, we would treat that as, like, say, a U.S. equity bucket, and then we just kind of integrate them into as part of the process.
Okay. That's why you build these as frameworks at the asset class level, because you're very flexible to clients having substitutes for whatever, like a default position you would buy if they just literally came with cash.
Right.
You're very flexible around substitute positions, that as long as that still adds up to the broad asset class level exposures that you wanted to see in the portfolio.
Correct. And we're trying to basically streamline it as best as possible. So somebody comes to us with like 4 SMA accounts that, for example, when you blend it, when you put them all together, it looks like the S&P, but maybe it's underperforming after fees and taxes. We'll maybe convert that into a direct index, for example, and that'll represent the U.S. equity bucket. We'll use an ETF. We'll use the client's existing positions, but we're looking at things both from an asset perspective as well as a tax perspective, because we don't want to just blow somebody out of a portfolio just so it makes it easier for us. We got to be able to work with the clients to make it the most tax efficient way to invest the money.
And so, I mean, I'm just trying to visualize how challenging does that get from an implementation and monitoring and like performance reporting perspective, when lots of clients have lots of different substitute securities. So like no one's got consistent, no one, but like a few clients have consistent returns, even in similar asset class frameworks, because they've each substituted their own like different stuff into it. That means your performance for the same asset framework varies depending on what they brought to the table originally.
Well, yeah, I think it's definitely a challenge. I mean, it's definitely a pain point of doing it. But I think if you look at the quality, I mean, there's a lot of quality investments that people bring to us. So it's not usually an issue of saying it's a good or a bad investment. It's usually that the investments aren't aligning up with the long-term plan. So there's a lot of consistencies to it. So, I mean, it doesn't really matter whether it's a Fidelity S&P 500 index fund versus a Vanguard large cap index fund versus a Schwab large cap index. I mean, those are all pretty similar approaches. So we're looking at the tax and saying, okay, while there's differences, they're not that different in the approach. So we're looking at tracking errors, we're looking at kind of consistency of the strategies, and then we're really just doing a lot of quality analysis. So if something's red flagged, it may take us a little bit of time to transition, but over time, if we're smart about it and we look at the tax efficiency over longer periods of time, we can slowly get them close to our frameworks and our ideal allocations. But it may not be day one. It may take us 6 to 12 months or even 2 years to get them to where we need to get them. We can do it in incremental levels to get as close as possible to our frameworks.
So you gather data in initial just like data gathering meeting, take it over to the planning team builds the plan, comes back to the associate and lead advisor. They do a review and make sure they're on board with how it shaped up, or I guess send it back with a new ticket if there's some adjustments that they want to see. So then I'm presuming next is a delivery meeting to the client, a plan delivery meeting.
Yep.
So how does that work for you?
So basically, we go back from the start and say, here's what you told us. So we're walking through the plan. We're showing them, okay, let's make sure the net worth report that we developed and all the accounts are lining up, which is that. We go into our assumptions of savings versus spending timeframes, what they're saving versus what they're spending in the future. The first meeting we present the plan, we're just going to really make sure that we got everything accurate. And we tell them, listen, we're not going to be 100% accurate day one because there's probably some things you didn't tell us in the initial plan, but we want to try to get 80 to 90% of the plan updated from the start. But we're going to have to go back and probably do a couple updates as the client thinks about it and sees the plan and comes back with changes or different assumptions with it. So we really are just, the first planning session is all about making sure, okay, do we actually capture what the client's current financial situation, what their goals are? And if we have to make some tweaks from there, we'll go back and do a second planning meeting where we'll make some adjustments to assumptions that the client brings to our attention, or different things that they hadn't told us in the first meeting. Because now they start to see that, okay, there's a process here, and they realize that they've got to make sure that they give us all the information so we can do the right job when it comes to our planning process.
And so are you coming into this meeting with like money guide printouts? Are you
We take
put PlayZone up on the screen and just do it live and interactively?
No, we come in with our version of the money guide outputs. We take some of the money guide outputs and we've actually formatted our own outputs to tell our kind of process story alongside of it. So we take some of the outputs from Money Guide Pro and put it into our own format.
Okay. And so are you coming into this meeting with like recommendations and action items as well? Or because it sounds like this is not yet, we're just in the, let's really make sure we're all oriented around the financial situation and aligned that this is the right picture.
Right. The first planning meeting is really about coming in. We're not coming with any recommendations. We're just coming to make sure, like, okay, does this reflect what the client's current situation looks like and what they're achieving? And are they on target or are they off target? And so we're really just presenting the facts they presented to us and say, okay, is this really the story that you're trying to basically achieve, right? And so that's what we're looking for: is did we get an accurate reflection of who they are, what they're trying to accomplish, and then are they on track or off track? And if they're on track, great. What can we do to make it better or more efficient? If they're off track, how do we get them back on track? That's what we're asking those questions in that meeting. And then usually once we basically come back, there's usually a couple edits. The second meeting we go to is we've addressed any edits we had to make, and then we're really trying to lock the plan. We're saying, okay, we all agreed that this is the plan. The second meeting. And so we verify that. And then the third meeting, we're coming back typically with our recommendations of how to actually implement the plan.
So meeting number one is gather data. Meeting number two, I guess, isn't really like a plan delivery per se. It's like a pre-delivery review. Here's the numbers and what we see. Here's the current trajectory of where you are that may or may not already line up with your original goals. If they are, you're on track and we can improve. If you're off track, then like we may have to come up with some more substantive recommendations. And then so then you do plan updates. I guess that's a new ticket back to the centralized planning team, right? They want to see this. We got to adjust that number. They forgot to tell us about this asset. We make some adjustments. We get a second version of the plan back. And we have I guess now we're like a third and final meeting where we're going to bring the recommendations.
Correct.
So
obviously the more complicated cases, it may involve more meetings. If it's pretty straightforward case, it may be able to do in one meeting. It just depends on the client's complexity and the accuracy of the data.
So out of curiosity, like, what do you have labels for these meetings internally of like discovery meeting, delivery meeting, whatever they are? How do you characterize them?
I think it's each team has their own spin on how they kind of position that with the client. Nothing is formalized across the firm.
Okay. So when you're getting a third meeting and it's time to formulate and deliver recommendations, like who's crafting recommendations? I mean, does this come from centralized planning because they make the plans, or does this come from lead and associate advisor because they've been the ones that are mostly interacting with the clients?
So say we've agreed to a specific set of goals and objectives in the plan, and we've locked the plan, and now we know what the asset allocation model that we need to kind of implement is. We're going to basically do an asset allocation to say, okay, here's how you're currently allocated, but according to the plan, we need to allocate like this. And then we really show them straightforward, like, here's how you go from A to B to get to that point. And we show them a full disclosure of here's all the recommendations, the trades, the investments, all the fees, everything's laid out to the client in a very clear format. They can understand how they go from plan to implementation. And then it really boils down to the client saying, well, do they need help with the implementation, or can they do it themselves? And so we always kind of tell clients, say, listen, if you there's no reason you need to necessarily hire an advisor. You should be hiring an advisor because they're going to add value in both the ongoing planning as well as the implementation of your portfolio and your plan. The question is, do you need more? Can you do it yourself? Do you need some coaching, or do you need us to run the process? Right. So there's 3 levels that we can work with a client. If you just basically just need some, the plan just to check off the box that you're on the right track and you're doing it yourself, that's great. Those are clients that usually don't engage with us, but they refer us to other clients. The ones that need a little bit of coaching may hire us from a consulting perspective. They're running their own process, but they want to have a check-in approach. And but the vast majority of clients, they hire us because they're not good at running process, right? They're going to let emotions take over. They make bad decisions at the wrong time. They're not going to stick to a process. That's when they're typically hiring us, under an AUM model structure.
So as you go down this path, I guess I'm sorry, is when do they actually become clients? I mean, this 3 meeting process. They're still actually prospects because they're
Yep.
not. It sounds like because they're not paying for a plan, and you haven't gotten to investment management yet. We're not even clear whether they're DIYs or want coaching or want you to run the process. So is this ultimately something you're doing with folks while they're still in the prospect stage?
Yeah, I think largely, I mean, when we get referred in, we have to, our goal is to see if we can add value to what they're doing, right? So usually on the front end, is you're doing the initial maybe introductory meeting with a client before you get into the planning process. You're really trying to figure out, is this a client that really needs your services or not? And what the scope of the process is going to look like. And then if they say, yeah, I want to go through the planning process, we'll make that investment in those clients, knowing that we kind of have a little bit of a background who they are potentially and what they're looking for. So I think we always say we just trust our stuff that if we deliver value to a client from a planning perspective, most likely they're going to hire us to implement that strategy if they feel that we've added a lot of value from the work products we've done for them.
And do you have? I mean, well, I'm going to imagine you obviously get a reasonable percentage of them that go through and convert because you're still doing it and have a multi-million-dollar firm. I
Right.
guess I got to ask, like, how many people go through this process that I got to presume takes a lot of time and ghost you or don't implement or just they're in the DIY or the lightweight coaching and they don't want actually you to run the process, which I'm presuming is the core business. Like
Right.
how much of a challenge is that?
Well, I think a lot of that can be weeded out because the client's really not going to. If the client's not going to take the planning process seriously, they're not going to be a client of the firm in the end anyway. So I think you weed them out in the beginning where they're not serious. If they just want to kind of like kick the tires a little bit and see what we do, we're not really taking those clients through the planning process because they're just out there kind of shopping performance or shopping fees or shopping some other things, but they're not really focused on really following our process of planning. And every time we go away from our process, that's where we get ourselves in trouble with clients because now you're battling a client, right? They're not really following your process. So are you really adding value to them? And so we try to weed that out on the front end when we just kind of meet the clients and understand the client situation. But usually once you go through the planning process, they're going to most likely become a client one way or the other, whether you're coaching them or whether you're consulting with them or basically doing a discretionary AM model. But you just kind of trust yourself that you've added value along the way. And I think it's a question of what service teams you're working with, right? So we have teams and team members that can cover all different range of clients, right? So younger advisors that are working with smaller size relationships, that are up and coming relationships, they need a little more coaching, right? But these are great, feeder ground for young advisors to be able to kind of learn a process, build relationships, and build their referral networks over many, many years. So we've always learned that if you give to get and you follow the right process and you deliver value to people, you're able to build that referral network pretty quickly.
So then how does this work from a business model end? Like what ultimately is the fee model for the firm?
It's a standardized AUM fee model. I mean, it's in our ADV. It's starts at 1%, works its way down on a tiered fee schedule. So that's the standard for our AUM, and we're pretty disciplined about it. We don't. Like I said, here's our value proposition. Here's what we do. Here's our fee structure. It's very transparent, and we're showing them here's what we do. And like I said, the clients know that going into this, they're going to see everything that we do, and we're going to give them all the recommendations on how to implement the strategy. So if they're comfortable doing it themselves, great. That's a client that can just take what we're doing and start it off, and maybe they come back a couple of years later and say, you know what, it was more complicated than I thought,
Uh,
and I want you guys to engage. Or maybe it's a situation where a couple may have one spouse that's active in the process, but then as they age or they become not able to run it, they want us to kind of step into that role and take it over. But the vast majority of our clients, it's a working partnership because it's more than just running the investments. It's the ongoing planning, it's the ongoing process management. It's really looking at the whole value proposition for their family. And so as long as we're delivering value, I think clients feel like the advisory fee that they're paying for it is justified. If you're not delivering value, you're just providing one component of the things, you're just doing asset allocation modeling, or you're just giving some generic advice. Well, then they're not really feeling that you're running the process for them. So it's probably not a client that you're going to want to take on long term, anyways.
and in your fee schedule, I think you said you start at 1% and start break pointing down over time. Where do break points start kicking in for you, and how low do you get?
It starts at 1% on the first 500,000, then drops down at 0.95, then it tears all the way down to like 25 basis points, I think, or 20 to 25 basis points.
Okay, so you get to 95 basis points pretty quickly, like after the first 500, just to start notching
Pretty much.
down.
pretty much. Yeah.
And
I
and then
think,
how high do they have to get before you get down to a number like 25 basis points?
I mean, I think, well, 25 basis points. I mean, I think with those ultra high net worth clientele, there's a challenge between as you get to clients above 10, 15, 20 million, then you're really getting kind of this more customized pricing models where you're pretty much like really large clients, 50, $100 million size clients. They're coming in with a different, mindset in terms of the fee
Yeah.
structures. So I think if you look at our fee schedule, we're pretty much, when we've done the benchmarking of our fees across the industry, we're straight down the middle of where advisors are. Yes, we're pretty much in line with the median average across the firm. But in the larger relationships, we're probably a little more aggressive in terms of the pricing model because it drops to those tiers. So somebody coming in maybe with like a 50 or $100 million account, instead of going through the tier structure, we're pretty much starting them at the low end of that tier.
And you said, like, in addition to the clients that want you to run the process, effectively becoming like ongoing discretionary AUM clients, you may have clients that want the more like incremental coaching sort of thing. So is that like fee for service? Is that you're billing them by the hour? Like how does that work when they want the
Yeah,
one in the middle?
it depends. It depends on what they're looking for. It's a function of what the work we're doing. So we try to basically either it's a rate times hours or it's a flat fee number based upon the scope of services. And the scope of services really depends on what are we doing for that. So a more recent engagement, we had a client basically come to us and say, hey, listen, I've got assets all over the place. I need to be able to centralize these things. And I'm looking for a team that can actually help me develop a process and technology to be able to link all my accounts together, provide me some coaching, but I want to run my own process. So we were able to kind of show them a digital model of a portal, how we can integrate everything from a technology perspective, and then show them a fee model that says, here's our costs, here's our technology input, here's our time we're going to spend, and here's our margin we're going to make, and we just show them here's the flat fee it's going to be. But they're running their own process, which is a different set of liability than if we're running the process, right? So you got to take into account the liability management associated with that as well.
So now help us understand just the growth of this multi-billion-dollar advisory firm attached to a CPA practice. So how does it work in trying to generate clients when you work within a CPA firm?
Yeah, the funniest thing about like working with the CPA firm is you got to learn what a CPA actually goes through, right? So you need to understand their business model, what they're doing with their clients, and really how you ultimately fit in terms of adding value to what they're doing. And like I said, that's hard to do unless you're embedded in the firm sometimes because like they're not thinking about every day like, okay, geez, I need to refer business over to the wealth management side. What they're thinking about is like a client's coming to me asking a lot of questions. How do I bring a team in to answer this client's questions? So that adding value from a customer service perspective is really the kind of the secret sauce of working with a CPA practice. If you're expecting the CPA to just open up the doors and just hand you all business left and right, usually doesn't work that way because the CPA is saying, well, why do I need to take any extra effort to go and bring you into a relationship that you could jeopardize if it's not really my core focus, what I'm focused on? But if you're saying, hey, let me show you ways I can add value to what your clients are doing and improve your customer service model, that's where you get the traction.
I think that is an interesting framing, right? If classically, like my best wealth management prospects are probably my CPA's best, business accounting, business services prospects.
Sure.
Except if that's their best business services prospect, they're already getting paid for that. So me getting introduced in is just the risk that I could screw something up,
Right.
not necessarily the benefit for them because they're already doing the accounting work they're doing for their client and ostensibly getting paid reasonably well for it.
Correct. And it says if you add value to what they're doing from a customer service perspective, because listen, the CPAs, it's tougher and tougher for them to do all the compliance work and then actually meet with all their clients all the time and go through and answer all their questions they've got. So we actually, it's nice that we're a non-billable source of value that we can deliver to the client. And then if the client says, hey, this is great planning, I want you guys to implement the plan, then that's how we get compensated is on the implementation side. But we get access to these clients because we're willing to make those investments in those clients to add customer service capabilities for the CPAs.
So can you describe that more? Just what do you mean by adding customer service capabilities for the CPAs?
I mean, it's around the planning. So most of the CPAs, they're billing as many hours as they can bill a year. So how do they take the time to stop and do what they're doing from a billing perspective on the compliance side to start all of a sudden pivoting to doing the planning side? So I think that's what we've identified as kind of the gap is that these clients are looking for more information and insight because the CPA sits at the center of the trusted universe of advisors. So these clients are coming in with every questions about Social Security, Medicare, what's going on with their life insurance policies, what's going on with their business, looking at all these different tax rule changes, and they have a lot of questions. And the CPA is going, well, geez, how do I answer all these questions when I don't really understand all the goals and objectives they're trying to achieve? And that's where we kind of come in as that value proposition on the planning side.
So structurally, you're literally under like common ownership to the CPA firm. Just like, is that how it works? I mean, the CPA firm has a financial incentive, at least the parent company level, to see the accounting side and the wealth management side work well together.
Correct. Yeah. I mean, so Marcum LLP, the accounting firm, is a shareholder in Marcum Wealth LLC, the RIA firm.
Okay. But to me, like, part of the takeaway of your discussion is, yes, but that's not really enough if you're building within a CPA firm and hoping to see activity, because the individual CPAs, I guess, it's like, frankly, may not care that much. They don't necessarily own that much of the centralized parent firm. They're not going to retire materially faster because they get their profit distribution on their ownership percentage, on their allocation percentage of a small slice of shared ownership in Marcum Wealth.
Correct.
That's a little too far removed from, or I can just serve my clients well and bill them my full hourly rate.
Right. And CPA alliances have been around for decades, right? We had those back in Morgan Stanley days. And like I said, that's nothing new. But the problem is they're not thinking about how they, they're not incentivized to just drive business to a CPA just for that. It's not going to move the needle for them, right? And like I said, for them, it's about how do you add value to their clients and them and their practices. And that's really what gets the CPAs motivated. It's like saying, hey, this is a great experience for my clients. And I always talk about it's the core feeling that they're going to get. So when a client goes to our planning process, the first thing they feel is they're in control, right, for the first time, because we've taken them through a process on planning that really engages them in this process. So it's not somebody telling them what to do with their money, but it's actively working with that client to develop a plan and a process. So that puts them where we've now empowered that client. And then they go through the process. The O is organized. For the first time in many years, they actually have everything kind of centralized in terms of a plan and a process on what they're going to do. That usually leads to the R, which is they're relieved, right? If they're off track, we've shown them a path to get them back on track. If they're on track, we show them how to make it more efficient. And the last part is the E, which is, basically they're engaged, and they're meaning that they're willing to make that changes that we want to do because we've actually got a plan and process in place. So they're energized to make that change in what they've been doing to have us take over that process. So, and we tell the CPAs, I said, this is what your clients are going to go through. And then we back it up with delivering that process. And then that's what the feedback is from the clients. And when the clients tell the CPAs that, they go, oh, that was a great experience for my client. Why wouldn't I do that for most of my clients? And that's how it kind of takes off. But you got to be able to kind of get in there, show that you're going to basically not take, but give. And that's the kind of the approach. Our firm is really built on a we approach rather than an I approach. And we really want to give to get as the kind of the mantra for our DNA of the firm.
So I'm still just trying to visualize more like how this conversation works with the CPA, right? You're hanging out in Marcum Wealth. There's a CPA over yonder in the other part of the firm that's doing, whatever is business services for a chunk of pretty successful business owner clients, which probably includes a couple of prospects for you at some point. So, like, what literally is the outreach? Like, how do you open the door with them? What's the conversation?
It's a lot of little things. It's doing events together. It's going to lunches. It's learning about their practices, taking the time to actually know who these people are and understand what their client base is looking for and how we can add value and showing them how we can add value. So it's hard work. I mean, you got to network. You got to basically press the flesh. You got to work the relationships. That's where it's hard being outside of the CPA practice, getting inside the CPA practice because we see them in the hallways. We're talking with them. We're having lunches with them. We're going and having a cup of coffee with them. We're just sharing ideas. And when we first joined our first accounting firm partner at Scotta Minotti, we would all sit around in a room with as partners and talk about how we can add value to clients and solve solutions for everybody. And that is carried through to this day. We continue to do that approach where we sit down with our CPA partners and they bring us ideas and they ask our opinion, like, hey, what do you think about this? Or how can we approach this? Or my client's going through this process. How can we add value? And we all share ideas back and forth. So it's a collaborative approach.
So understood, but I feel like almost any advisor I know would say, well, I provide valuable financial planning. It's clearly a value add for any CPA and their clients who don't already do that. But most of us are not getting like an avalanche of cross referrals from
Right.
CPAs, even though ostensibly we're bringing the value add. So what I'm still just trying to understand, like, what's different about what you're doing and every other advisor that offers value added financial planning to every CPA they know,
I
and
don't think
it's not getting the results you are.
I don't think it's well. I think it helps that we're embedded inside the firm. We carry the same brand, we carry the same card, and we're living day to
Okay.
day together with each other. That's definitely an advantage we have that drives the referral process. Because without that, if you're not in the building, it's really tough to really make those day to day connections. Which
Yep.
like I said, we'll have situations where a CPA will walk a client into our door unannounced and say, "Hey, I'd like to introduce you to so and so." That's great. That's part of the magic that happens. But it's us also understanding their practices and what they're going through, and understanding what their challenges have been, and really learning about how their businesses are operating and where we can add that value component, and then really trying to work together to drive opportunity sets, to doing co-events together, going to the same networking events, and then really making the connections back and forth both ways.
Are there particular value add conversations, offerings that tend to resonate more, that tend to open the door more readily?
Um, I think I think it depends on the client situation. So, for example, I think where we see a lot of unique opportunities is really in the middle market business owner succession market. So we have a bunch of our firm advisors or CPAs, certified exit planning advisors, which is
Okay.
a big advantage for being in the accounting firm market. So a lot of the firm's top clients, okay, are going to be these middle market business owners that are always going to be being approached by private equity to sell their business, right? And it's these are the bread and butter clients for almost all CPA firm practices. But at some point, these clients are going to look to monetize their business, and so your top margin clients on the accounting firm side can all of a sudden be taken away because somebody comes in and buys the business. But
Right.
if we work along, so one of the things we do with a lot of the CPA partners of their business clients is develop a business plan for the business that's in line with the personal financial plan. So we're making those investments early on to get a seat at the table, so that when there is a liquidity event or the client's contemplating a liquidity event, we're helping them guide them through that process. And then I think they see the quality of the work we're bringing to the table, the planning we're bringing to the table, so that when the liquidity event does happen, they're choosing us to be able to implement the strategy post the sale of the business.
Interesting. And I guess anything that helps to address or maybe fend off or forestall that conversation, that liquidity event for the CPA effectively is good news, because they just get to continue doing the work with the clients that they're already working with.
Yeah, I think it's maintaining it in house for the firm, and I think it allows us to be able to provide kind of resources to be able to maintain the connectivity with that client over the long term. So it may shift from doing more like business corporation tax work to more estate work, right? The state management approaches. So you're still maintaining them as a tax client, but maybe we're not doing as much work on the business services side. We're doing more work on the personal side for that client. So maybe it becomes more of a higher end private client services client for the firm.
Is that still challenging in the CPA world? Because I got to assume, like, whoever does the accounting services for the business may be different than whoever's providing some of the other personal services.
It's still largely the same people. I think it's just a question of they've always been doing the personal side of it. So if you're the business owner, you're having the same team that's doing your business taxes also doing your personal tax work as well. There may be different team members that focus on different aspects of that. So maybe if you've got
Okay.
your corporate tax side, then they bring in other CPA members from the personal side to kind of work alongside that lead partner. But usually the lead partner is maintaining that relationship for the firm.
Now, I think you had said earlier that ultimately each of the advisory teams build their own focus. So, like,
Mhm.
some pursue business owners, as you've said, like, and have their CPAs. But I think you said there's another group that's focused on physicians, another group that's focused on blue collar clients. So help us understand more the way these different advisory team focus groups work.
Yeah, so we kind of have the diamond model, if you're familiar with that kind of
Yep.
concept in place. That's kind of what we built the firm around, is that each diamond has its own unique characteristics based upon the clients they're servicing and their client service needs, right? A traditional diamond model would be a lead advisor. On the one wing would be basically your associate advisor that works with the lead advisor, and the other wing is basically going to be your dedicated kind of customer service representative that's going to do all the kind of behind the scenes work with the client. And then you got generalized support of the firm at the bottom of the diamond. And then that diamond may, depending on your service model, may require some additional components, right? So you may have to have additional. If you're doing more higher volume, lower AUM type clients, you're going to have more customer service needs that you're going to have to service. You have to staff for that. So each model we're trying to basically do is look at the profitability of each team, how they're operating, and make sure they're staffed effectively to deliver the service model for that client base.
And is there a particular profit margin or threshold that you target and work back to? Like how do you figure out what those numbers should be?
Yes, I think it's a work in progress for us. So obviously, we need to continue to upgrade our accounting software to be able to do that analysis. So that's something we're focusing on as one of our kind of our core tenants in the next year or two, is to really get the financial reporting systems to be able to do that more accurately, because it's basically a manual approach to kind of do those analysis today. But as we continue to build out accounting system capabilities, we're trying to basically solve that solution. But there's no perfect solution that we can just buy off the shelf today.
But
And that
ultimately, the goal is, look, you want to do a high volume, low AUM client base. You want to do a low volume, high AUM, right? Like ultra high net worth client base. The firm's perspectives, the team is, here's the margins that we're expecting you to be able to get to. So you can structure yourselves however you wish
correct.
in those different combinations and trade-offs. But at the end of the day, a certain amount of revenue should have a certain amount of cost to service that revenue that drives a certain amount of profitability for the team. And that's what we're going to hold you accountable to.
Yeah, and I think it's also staff utilization. So as you're bringing on younger advisors, right? So you should be able to help, those younger advisors should be able to service a wider range of clients as they learn the experiences that they need to along the way. So you just got to manage staff utilization, profitability, revenues, cash flows to make sure you're not underspending or overspending, for the particular client segment you're going after.
And how do they pick the segments, the focus areas?
I think a lot of it's just what their personal networks should look like. So obviously we have their connections to the accounting firm, but obviously they have their own networks and what they're good at. So for example, one of our partners was a former nurse anesthetist who got into the business many years ago, and he went to Merrill Lynch, and then he joined and set up his own RA practice. So he had a lot of connections back to physicians, and he had a natural market for them because he knew them. Whereas I don't have that necessarily access to those
Right.
people. So, so that's where a niche kind of developed, and they continue to build upon it. And just, once they got solidified in that network, and they just were able to get more and more referrals out of it. Some
And
people
and
golf, some people do sports, some people do other activities, community involvement. So we kind of leave it up to the advisors to say, okay, what is your natural market versus the CPA market, and how do you make those connections?
so how many different teams and focus groups are there now?
The main groupings are our Philly team, our Connecticut teams, our Cleveland teams, our Akron teams, our New York teams, our St. Louis teams. So we have them kind of by areas and regions, and then under
Okay.
all those office locations, then we have kind of subgroups and what are they focusing on. So, for example, the Akron market, we've got a couple of different advisors working that Akron market for us, and one's focused on, like I said, like the medical practices and medical services providers. Another one's kind of focused on his connections with the community. So it just depends on what their natural markets are, but they're all still tying back to our process of how we work with the CPAs, because obviously that's where they've still got their own network of clients to bring in outside of the accounting firm as well.
So I guess I'm in that context. So it's not like they're marketing. It doesn't sound like they're marketing their own sort of specializations independently. It's not like they've each got their own mini website of I
No,
specialize in doctors and such. Everything still feeds back to Marcum Wealth as the core advisory firm. This is like their local on the ground marketing approach, or their local Marcum CPA related folks that they're networking with to position themselves this way.
correct. We're not really doing marketing it to the public. I mean, we're almost exclusively referral driven across the board. I mean, so we're marketing to maybe the CPAs internally at Marcum to make sure that they understand what we can do for their clients. But we're not really doing like a lot of advertising the markets. We're doing the traditional stuff: community support, sponsoring events, things like that. Doing our own events. We're providing content to the areas, but we're not like going out there and buying lead lists and calling on people and marketing direct to consumers.
And just how does growth break out at this point between what comes from the accounting firm as a crossover versus presumably some referrals from existing clients because you've had a lot versus just strangers to the firm that somehow
Right.
find their way to you. You go to your local networking meeting and build a relationship with the prospect.
I mean, generally, I think it's been about, we've looked at the business over the years and different things. As my business partner, Chris, and I first started the business back in 2006 with the accounting firm. Historically, our business has been about half the business is coming from the accounting firm, half is coming from our own networks, which is kind of what it seems to be. We've talked out of the firms inside the same similar models. That seems to be a standard approach. Where if you're solely relying on CPA practice, you probably haven't developed your own personal network enough. So the idea is trying to find balance between the two.
Okay.
What we do find is that it takes a little time to build that thing. So so when we brought new people into Marcum Wealth over the years in terms of acquisitions we've done, the first year is really about them making the transition. The second year is about them really building their network in the CPA practice, and the third year is where they start to see the results of the work they put into in terms of building their brand within inside the CPA partners. That seems to be a pretty standard approach. It's a multi-year process to kind of get ingrained with these CPAs. It's not going to happen day one. You got to continually give to get, and you got to continually earn your spot. But if you're expecting instant results, like you're not going to see it instantaneously. It takes a while to build these relationships and build the network and really establish trust.
So, to what extent is acquisitions part of the growth strategy for you when you've sort of already got some flow coming from the CPA firm as is?
Well, that's for us. That's the big challenge. Is obviously we're not covering all of Marcum's offices today. So if we look at the world today, we're in maybe 7 of the 40 plus offices. So we can't cover the entire network as is. So we're out there looking to either hire advisors or do acquisitions where we can basically provide a process that they can kind of bolt onto. And I think as an advisory firm practice, they have to kind of make that decision. Can we, if you're going to join another practice, can they do anything? Can they do more than just offer a platform to work off of, right? In terms of, today you can buy off the shelf solutions in terms of trading, rebalancing, reporting stuff from all the different major providers. That was one of the big things that allowed the RIA business to kind of bloom and prosper, is that the technology became ubiquitous. You didn't need a big firm to be able to to leverage technology to set up these businesses. But now the challenge I think a lot of firms are having is how do they grow the business organically rather than just market growth, right? And you got to have a certain amount of scale, process, and a network of centers of influence to be able to feed the machine to make it work. And so for us, our focus on growth is definitely acquisitions as part of that process, but we have to be able to deliver acquisitions the resources they need to grow and prosper to make it worth their time to come into the practice. And there's a bit of a challenge with that because we're not right for everybody, right? So I think that's the thing we have to be discernible about when we do mergers, is that are they going to fit in with what we do? And we're very upfront about that. There's a certain way we do things. You got to kind of follow our process. You got to kind of do it the Marcum Wealth way, which is a bit of a challenge because, like I said, one thing we know about this industry, we've got a lot of strong personalities in this industry, and everybody wants to kind of do it their way. And we got to, as a firm, we've got to do it the Marcum Wealth way because we have to have consistency of our deliverables across the infrastructure in the enterprise.
So it sounds like for you, a material aspect of acquisition opportunities is finding a firm in locations where there's already a Marcum accounting office, but you don't have a wealth management presence, and that's a way to stand up the RIA branch in that location.
Correct. And so some of those could be, what's interesting, we've had both mergers, we've done that where we've found a market where we need to put somebody into it. And we've also done acquisitions where Marcum's acquired CPA practices that actually have RA practices that need a little more horsepower built around them. So yeah, so for us, I think, day one has always been about, trying to get a footprint, in the markets where Marcum's got a footprint that are sizable, and then continue to build upon that. And, just trying to figure out because we are a separate company, one of the challenges is that we have to kind of run our own capital stack and our own access to capital outside of the accounting firm. So we've got to figure out, one, can we afford to do the acquisition? Two, is it going to fit in well? And like I said, we've danced with a lot of people, but ultimately, like I said, it's got to be the right fit. So we can like the team that we want to bring into the practice, but if the accounting firm guys don't want like that, the firm we're talking to, it may not actually work out, right? So the personalities have to line up with both those local markets and the regional regional teams that run those markets. So it's not a perfect, easy thing just to bolt on advisors. You got to find people that are going to want to do it our way. One, can integrate with the CPAs, and two or three would be the patience to let the things develop. right? Continue to work and develop and trust the process. That's going to eventually lead to good results. Because I think some people come in and say, "Well, I expect instantaneous results," and it's just not going to. It's just not going to work that way. They're not going to just floodgates aren't just going to open because you throw up a shingle and say, "I'm a Marcum Wealth advisor" and sign of an office.
So, are there particular markets that you're trying to be in right now, or like cities and locations where the CPA firm has a presence and you wish you could build one?
Yeah, I think for us, like today, I think we're looking at markets like South Florida. We've got a pretty good connection in the Tampa market today, where we've been for a while. But I think Miami, Fort Lauderdale are big practices for Marcum. Boston is one market we're looking at expanding into. New York, we want to continue to build out New York, LA, San Francisco. Most of the Super Bowl cities where Marcum's got a presence, those are the areas we want to do. What we have to look at in the accounting firm model is you got to go one step deeper, because you got to look at those offices and say, what is their tax business versus their audit business? So we are restricted in some of the clients. We can't work with every client inside of Marcum because there are AI-CPA rules and independence rules that we have to kind of follow. And we can't conflict with audit process because there could be a conflict of interest. So we kind of more focused on where we can add value on the tax side to the tax partners. That's more the focus than it is on the audit side. But there is crossover. The audit partners do have personal relationships with business owners that are not doing audit work that we can definitely provide value for them on those situations.
Oh, interesting. So it's not enough just to reflect like, hey, this is a big CPA practice, because the CPAs within the practice have a lot of different subsets of services, and audit is a particularly challenging one to have multi-relationship with
Yeah, because
versus.
you really got to be paying. I mean, you could really do a lot of damage if you violate the independence rule. So we have conflict checks that we have to go through, and there's a lot of behind the scenes work that to make sure you stay compliant both on our side as well as the CPA side.
And so thus the focus on not necessarily audit locations, but the ones that are doing tax and small to mid-sized business accounting, because the accounting
Correct.
work is separate from the formal audit attestation side of the
Correct.
business.
Correct.
And is there a particular size or profile of the kinds of firms that you think about acquiring when you're I mean, I'm presuming you've kind of got a balance. Ideally, it's a practice that has some reasonable economics unto itself, but if you're trying to get presence and capacity in a city, like, you don't necessarily want to get the traditional, like, it's a pretty profitable advisor who's going to retire and wants to sell their business, because that doesn't
No.
give you capacity if they're
Well,
going to retire. Like, you're looking for a different type of deal.
right. That is definitely a challenge, because the worst thing we can do is bring an advisor and that's just not going to like develop the office, right? So, we don't want to acquire a book of business just to acquire a book of business. We want to bring advisors in that want to grow and that want to basically do more advanced work with these CPAs, right? Because I mean, the advantage of working with the CPAs is you can deliver tax advice and other things that you just can't do as an individual advisor because you're not a specialist, you're not licensed in it. But when you can collaborate with the CPA directly on a client case and you're working together, you can really do some creative planning for clients that they just hadn't really thought about or hadn't seen before. So for us, I think it depends on the market size. And it depends on the office size. So larger offices, like say our Fort Lauderdale, Miami markets, they typically would require a bigger team to kind of come in, because I think it's like this gravitas of, like, if you bring a more of a team in for those bigger offices,
Right.
it does pretty well. But if you put a big team in a small office, like then it overwhelms the CPA office, right? I think it's trying to find the size of the team relative to the size of the office that can make the most sense. And so, for example, like in a smaller market, we maybe just hire an advisor directly. So we've been working with a young advisor in the Nashville market that we brought in that's had a lot of success now, starting from scratch, leaving a trust company and now developing his practice inside our Nashville market. That was a market that was probably only going to support one advisor for the number of tax professionals they had, but he's now been able to get good traction with it. And then as you go from a small office with one advisor, then you bring in to a mid-sized office, maybe you're bringing a team in, and then for large markets, you probably have to look more of a lot more. There's a lot more people to cover, and there's a lot more things you have to do to kind of get traction in that market.
Is there some ratio that you think about of like how many advisors per tax professionals, or how many advisors per like tax and accounting clients? I can staff one advisor for every X tax
Yeah,
professionals or tax clients in a market.
we kind of look at it, but it's no hard and fast rule. It's just more a question of, really understanding those offices. And so we try to do is we really try to work with the Marcum office leaders and regional leaders to understand what's going on with their market, what their strategy is, what their growth propositions look like, their focus of their clients, the focus of the CPAs, and then really just try to figure out what's the best fit. But we do have to, one of the things we do have to do is we don't just make an offer to an advisor without talking to our CPA partners, right? So the CPAs are directly involved in any sort of acquisition we do in a market or any new hires in a market because they really have to buy in that this person's going to fit within the organization, and especially not only our organization, but Marcum LLP on the accounting firm side.
Okay. Because at the end of the day, you need to make sure that when that advisor or firm comes on board and starts showing up in the local CPA office, that like they are happy to have him or her around and engaging with them and not saying who is this person? I don't like them.
Right.
Please make them go away. That's not.
And I think the CPAs pick up on the energy you bring to the table. So, for example, if you bring an advisor in that's just sitting, reading the newspaper at his desk and not integrating with anybody else, then it's gonna be like, okay, why would I want to work with that person? Right? They're not really bringing the energy and they're not really bringing the ideas to me. So why am I going to waste my time reaching out to them? So I think that part of it is you have to kind of come in that give to get mentality and ask questions and integrate and talk with the CPAs and learn about what they're doing and show them how you can add value. And it's not a simple task. I mean, it's something, and you have to do it consistently over time to build that trust. But if you do it the right way and you trust your stuff and you give value to people, then you're going to have a pretty good likelihood that they're going to think about you the next client situation that pops up, which is usually around, hey, a major life event or something they have a question about. Like, so without having that, connection to the CPA, it's really difficult to make those inroads because they're not thinking about you when that client conversation comes up. But if you've put yourself in the right spot with that CPA, when the client situation arises and they say, hey, I've got a great person you can talk to that can help answer these questions, that's when the referrals start to happen. But you got to earn that seat with that CPA.
So you're nearly 20 years into this journey now. So what surprised you the most about building an advisory business and doing it within the context of a CPA partnership?
It's I guess what's surprising the most is how you have to continually evolve at every stage of the development of the business. So you start with a very simple, easy practice with a couple of people, and then it continues to evolve as you grow. And as you continue to grow, you have to keep reinvesting back in the business. And it's always that balance between, how do you find that the right people relative to maintaining the profitability of the firm, relative to the right deliverables, and it's a complex approach because it's like it's how do you build a business within a business, and it's not, like I said, I didn't have any formal training, being CEO. I always thought myself was a pretty good advisor, but it's been on the job learning to be the CEO. And like I said, it's always more challenging than you think it's going to be, right? So there's a lot of things you never thought about that you have to make decisions on. So that's one of the very interesting things about doing both an advisor role and a management role. But then at some point, I think one of the things is saying, like, what do you do next, right? And then being able to kind of delegate things down. I think that's always a challenge for advisors. Is I think a lot of advisors want to control everything. And then in order to build scale, you've got to be able to let things go. So you got to be able to trust your planning team, trust your research team, trust your your trading team to be able to do their roles as part of the process and finding really good people to fulfill those roles in the organization. So it's always, to me, is always a lot harder than I thought it was going to be. But it's also, but that's the cost of building a successful practice. It's going to always be more work than you think it is.
So what was the low point for you on this journey for yourself?
I would say the low point is just the amount of time it takes to run the business. So, when we were at Morgan Stanley, life was pretty easy, right? I could take a lot more time off. It was a simpler time. I didn't have to worry about all the stuff, right? Running the business, payroll,
Yep.
capital, people. I just kind of did my job as an advisor, and Morgan Stanley handled the rest of the stuff. And, I could just like turn things over and vent to them when I didn't like what I saw. When you run your own business and you face challenges like 2008, 2020, 2022. I mean, those are tough decisions because you've got to be able to make business decisions on top of being an advisor decision process. So the low points are like when you get into stress periods where you're either trying to break out to growth or you're having to deal with potentially the challenges of the things we don't control, which is the market outcomes. Those are where you really test your desire to kind of want to do this every day, right? As in terms of running a business as well as being, an advisor to clients.
Which one of those turning or transition moments were worst for you?
I think the thing that scared us the most was, we launched this business 2 years before the great financial crisis in 2008,
Yep.
right? And so, all of a sudden, the economy is zooming along, and we launched this RIA practice, effectively December 15th of 2006. So a year and a half into it, it's 2008, things are starting to go down and become uncertain, and we're trying to build a practice, and we're like, how do we get, we weren't profitable at that time because we had to make investments in hiring people, and we didn't bring every client over from Morgan Stanley. We brought over the ones that, that fit our model where we wanted to go. But when you have a market that goes down 50% in the first, 12 to 18 months before you launch your practice, it's how do you rise to the occasion? So I think there's a lot of sleepless nights leading up to building to the launch of the practice and carving out of Morgan Stanley to then going through the financial crisis. Those first 3 to 4 years were just really stressful because we had to prove that we could actually do what we said we could do to the CPA practice. But in reality, 2008 turned out to be the turning point for us because in 2008, people realized that a big firm like a I hate to beat up on Morgan Stanley, but whether it's Goldman Sachs, Morgan Stanley, the people raised a lot of questions about their independence and safety of those assets in the wake of Lehman Brothers. And I think people realized that the RA model really had come into its own fruition, and people were starting to realize the independence and the fiduciary approach that we were delivering as an RA made a difference for them, knowing that there was no alternative agendas that they had, so they could trust that the advice they were getting was the right decision in very volatile times. So I think once we proved that out in 2008, we actually had a blowout year. It was one of our biggest years of net new assets, and that really proved out to the CPA practice that we could thrive in all different environments. And we've actually shown the CPA practice over the years that we have only had one quarter of basically flat growth since we launched the firm. So we've had quarter over quarter growth since 2006.
If you had to, can start not profitable as you're trying to build the infrastructure and clients are still coming over, like, I'm just curious, how long was it cash flow negative, and who has to foot the bill in that context? Like, does the CPA firm come to the table on that, or did you and your partner also have to be out of pocket to get things going?
So we launched with it was actually a benefits firm that was a partner in the practice, and then the CPA practice at the time, Scott and I was a partner, and then Chris and I were partners, and and they brought us in, and they backed us out of the gate, and were they happy that they had to keep putting money into the business in a period of difficult times for both the CPA business as well as the RA model?
Yeah.
I think they raised a lot of questions, and I think we had to have the answers. But I think we showed them like there was a path forward, and we can model out, like I said, if we bring in this amount of assets, here's the date we're basically going to be cash flow positive, regardless of what the market outcomes are. And I think when we showed them the path forward to how to really grow this business, and we showed that we could deliver the value and the results and provide really a great customer experience in a very difficult time for their clients, that's when the magic started to happen. They said, hey, we can back this play. But do we have an unlimited time frame to do that? No, we had a very short shot clock to make this thing work or not work.
How long was it before it turned break even? Like 2 or 3 years?
Yeah, it's about the third year. So it's probably like 2009 when the market started to basically turn the corners, when we had already gathered all those assets in from the previous year in 2008, that we basically then saw the growth. And we started getting some of our first large clients, those first $10 million and $15 million clients started to come in the door. And that really moved the needle for us because we're obviously a very small group, but we were able to kind of bolt on the assets to get to cash flow positive pretty quickly.
So what else do you know now that you wish you could go back and tell you from 20 years ago when you're still thinking about leaving Morgan Stanley and going independent and like building in the CPA firm world? What do you know now you wish you knew back then?
Uh, I think the biggest thing is like I think I wish I would have had more of an understanding how to run a business before we launch the business. Right? That's always like learning on the go
Yeah.
is hard, but sometimes you have to make decisions. I mean, you hope you make the right decisions, but I think that was the biggest leap was to say like if I had some more kind of training and like things like everything from compensation models. I mean, so we had to figure all this stuff out. Now we had some great partners in the accounting firm that helped us do that. With partners like Greg Skoda and Michael Minotti, who were the original partners of the accounting firm, helped us do that. So having that mentor in the business definitely made a difference. And I think so. If I look back at not having a mentor early on in my Morgan Stanley career, probably could have saved me a lot of headaches had I had more outside counsel that I could have relied on to make better business decisions. So having that board advisors, and other partners that you could bounce ideas off of and reality check them makes a difference.
So, what advice would you give younger, newer advisors just looking to come in the profession and get started today?
The challenge is you got to be patient, right? I think young advisors try to get in the door, and it's like, okay, great, they can get their credentials, they can get their CFPs, but how do they add value when they have limited life experiences, right? So it's hard. It's hard to kind of just be able to just kind of walk in the door and just make things happen, right? And so a lot of the advisors you see that are successful today had spent decades working relationships and centers of influence and networking events to get their core client base. I think the younger advisors coming in struggle with how to actually build businesses, build their personal books of businesses. And so I think for us, that's an interesting challenge that we always have to kind of deal with.
And so, how to what are new advisors missing in how to build their books of businesses?
I think it's just the amount of sheer effort it takes to be able to build your brand and build your
Mm,
network. I think that takes a lot of energy and effort. I mean, it doesn't just happen because you have a business card and you got an email address. You've got to make the case
mm,
to your centers of influence why you and how you can deliver value, and you got to meet enough people to get that referral process going. But once you get it going, then it feeds upon itself, right? So it's that initial challenge. And so one of the things that we always questioned about like the brokerage industry before we launched our own firm was there were so many people that would just come and go. And I think at the time, we had hundreds of people go through our training classes in the 10 years I was at Morgan Stanley,
yeah,
and very few of us ever made it. Like I think 5 of us out of 300 plus people made it as advisors inside of Morgan Stanley. That's not a good way to run a business
yeah.
long term. So a lot of the younger talent washed out. And a lot of it was, it's just they didn't have the centers of influence or they weren't putting the energy in to make the connections. We've tried to change that a bit by saying, okay, we don't want our younger advisors out there necessarily doing business development day one. We want them learning from the lead advisor. They want them learning from not just the advisor they're working for, but the entire organization. You want to pull that knowledge that I have in my brain and how I deploy it to my client base. I'm teaching the next generation to go along, because if I make that investment of time in them, then they're going to be able to prosper and grow inside of our organization. So I think that's the biggest thing is like we've got to do more, and the advisors that we hire have to do more to be able to kind of learn from each other, and really be able to get them out there networking. It's hard to market. I mean, when I started, you could cold call people, right? Today, you don't have the ability to cold call, so you've got to do it, in certain degrees, other harder ways. But we do have a leg up on that because we do have a network of CPAs they can tap into, but they got to go do it. It's not just going to happen magically. You got to work the relationships. You got to put the time in. You got to get to know these people, and it's hard when life gets busy, right?
So, as we wrap up, this is a podcast about success, and just one of the themes comes up is the word success means very different things to different people, and so you've been down this wonderfully successful path now of building this multi-billion-dollar advisory firm, and so the business is clearly in a wonderfully successful place. How do you define success for yourself at this point?
I would define success for me as just being able to, say, did we do what we the best thing for our clients at all times? Do we really make sure we added value to our clients' lives, right? I want to make sure that the people respect the work that we did and that we added value to what they were doing. I think that's how I measure everything by. It's like the give to get mentality. If we're doing the right thing, then the success will follow. And I always told people, I said, when they come to the firm, I said, you can either do what's right for yourself or you can do what's right for your client. And my philosophy has always been, if you always do what's right for your client, you'll get taken care of long term. But if you do this job to make a buck, you're probably doing the wrong thing, right? And we used to see that in our industry. It's maybe not as bad as it was maybe 20 years ago, right? Where you had just a lot of the product sales in the industry. And I think we've evolved. So, but I still think, I think people have to look at themselves and say, am I doing what's always in the best interest of my client? And if I'm doing that, the success will follow. And that's how I look at things. Do my clients respect, and does the firm's clients respect what we do as an organization? And that's the key to our success, because that's how we get new business is exclusively largely through referrals. So it's kind of a feedback loop. If you're not doing what's right for the client, you're not going to get the referrals.
Well, I love it. Thank you so much, Eric, for joining us on the Financial Advisor Success Podcast.
Thanks for having me.
Thank you.
Want even more ideas, tools, and resources on how to break through to the next level of success as a financial advisor? Check out the leading financial planning industry blog, Nerd's Eye View, at www.kitsis.com, where Michael covers the latest practice management trends and financial planning strategies. And by joining the members section, you can earn IMCA and CFP continuing education credits, along with exclusive member content. Get it all now at www.kitsis.com.